Welcome to a new video from Irrational Investors. This is an investment thesis on Crocs, focusing on the deep value we think is arising from the market mispricing of a best-in-class core brand due to a temporary divisional challenge.
The Crocs brand is a high-margin, cash-generating powerhouse, currently obscured by HEYDUDE's inventory correction. The opportunity is to acquire a world-class franchise at a deep discount, with HEYDUDE's turnaround acting as a free call option. Our rating is overweight, with a $145 price target. Despite consistently beating earnings expectations, the stock has derated significantly. This is a classic sentiment-driven dislocation, where fear of future guidance outweighs present-day reality. This is what we call the divergence between the technical momentum and the fundamentals momentum. The issue lies with the recently bought brand HEYDUDE. The acquisition aimed to scale a fast-growing brand, but wholesale channel saturation led to issues. The fix the company is implementing is a strategic action to restrict sell-in to clear inventory, resulting in a temporary minus 21.7% revenue growth. The performance matrix shows the consolidated negative results are almost entirely due to the HEYDUDE cleanup. The key takeaway is that Crocs brand resilience, through its international growth, is masked by the HEYDUDE wholesale reset. While investors focus on North American weakness, Crocs is booming internationally with plus 5.8% growth. Diversification across China and Europe acts as a natural hedge against U.S. saturation.
The revenue evolution demonstrates the brand's ability to scale significantly post-2019 restructuring, showing consistent structural growth from $1.2 billion in 2019 to $4.07 billion LTM. Of course, this includes the acquisition of HEYDUDE in 2022. All taken into account, this is anyway a significant growth of 190% in the last 5 years, since 2020.
The core Crocs brand benefits from the Croslite moat, a proprietary material enabling low-cost manufacturing and delivering software-like margins, 58% gross margin. Even with HEYDUDE, Crocs' operating margin is approximately 25%, superior to peers like Deckers and Skechers. In this regard, the HEYDUDE situation could compress the operating margin further in the short term. Crocs converts an extraordinary amount of EBITDA into free cash flow due to its low capex model, generating about $769 million LTM FCF. Cash is being used to rapidly deleverage and repurchase undervalued shares. Management has aggressively deleveraged the balance sheet, reducing peak debt from $2.6 billion in 2022 to $1.32 billion in Q3 2025. This results in a healthy net leverage of 1.5x EBITDA, mitigating solvency risk. Management is signaling undervaluation through aggressive share buybacks. They repurchased 2.4 million shares in Q3 2025 alone and have $927 million remaining authorization. These buybacks are highly accretive to EPS at a 7x PE multiple. Our financial projections assume a transitional 2025, followed by modest growth of 3 to 4% driven by international expansion. This translates to a moderate increase in adjusted EBITDA and free cash flow through 2029.
We utilize a triangulated approach for valuation, DCF analysis, reverse valuation, and sum of the parts. All methods suggest an undervaluation of the company.
We use conservative assumptions for our DCF model, including a rounded 10% WACC to account for execution risk, and a 2% terminal growth rate matching long-term inflation. The DCF valuation yields an intrinsic value per share of $192.92. Even with conservative growth assumptions, the stock is trading at a significant discount to its DCF value.
The reverse valuation, using the current price, implies that Crocs' profits must shrink by over 4% every year forever. This contradicts the reality of a core brand with high margins and global growth. Our sum of the parts analysis tests the HEYDUDE is zero thesis. Valuing the core Crocs brand alone gives us a fair value of about $127. Buying at the current price means you are receiving HEYDUDE for free.
Crocs trades at roughly half the forward PE multiple of Skechers, despite having double the operating margins. This highlights an attracting anomaly in peer valuation. The other comparables are also as favorable.
Key risks include permanent HEYDUDE impairment with the immediate impact in the P&L, a weak U.S. consumer impacting discretionary spend, and geopolitical risks, such as potential tariffs on production concentrated in Asia. Be aware, don't expect a peaceful journey anyway. This could be a bumpy road, and that is precisely something the price is signaling. The path to the conservative $145 target price, instead of the $192 from the DCF, is supported by clear catalysts. These include fundamentally the HEYDUDE stabilization, the realization of $100 million in cost savings, keep on with aggressive share buybacks, and a valuation re-rating from 7x to 11x PE. The final verdict is an asymmetric risk-reward. Downside is protected by valuation floors and buybacks, while probable upside comes from HEYDUDE recovery and durable core brand growth. With everything in perspective, our recommendation would be to initiate a position at this levels.
That's all. Thank you very much for watching our analysis, and for more ideas and investment tips, go to our website, Irrational Investors, www.irrationalinvestors.com. See you soon. And please, remember that this report is for informational purposes only and does not constitute investment advice.